Thanks, Tom. We did have one question out there about whether active or passive outperformed this year. I don't know if you had any data ready for that.
Yeah, I have been running that data, and the active actually underperformed the passive. But I think the numbers that I was looking at, and by the way, when I was saying that, I was looking at relative performance to the manager's benchmark. And when I started taking into account the expense ratio differences between that and an index, I don't know that I could put a lot of claim into the fact that they got beat. So yes, passive did better than active, but when I take a look at active and I start thinking about the expense ratios and the kind of stuff for active management, it was kind of a push, so to speak. So, but yes, passive beat active once again. But if we take a closer look and start looking at the active managers and that they have to charge a little bit more, overall they did okay.
Well, excellent. Okay, so I'm Jeff Tjornehoj, and I present on fixed income. One of the common themes that both Tom's and my presentations will have is a continuing quest for income. As Tom pointed out, value beat growth in equities. I think a lot of that can be attributed to investors looking for that little bit of income, something to help tide them over in times of uncertainty. It turned out to be a very good quarter for equities, but no one knew that going into it. We still had a lot of lingering concerns about Europe. This period also included the presidential election, what would happen with the fiscal cliff, what would happen with tax rates, depending upon who became the president. So I think there was a lot of trepidation in the markets, and we saw that in equities. We're going to see a little bit of that in fixed income as well. One of the themes that I presented in my paper that just came out yesterday, reviewing the fourth quarter, was the new Evans rule. And this is Charles Evans. He's the president of the Chicago Fed, and he had been, I'll say, a bit of a thorn in the side of the Board of Governors, saying, when we're talking about quantitative easing and keeping a zero interest rate policy, what do you mean? When do we stop doing that? And for a long time, the statements coming out of the Fed had simply said, we will continue to be accommodative until the economy gets better. And so Fed officials, as late as September, had said that they would just keep buying long-term bonds until unemployment improved substantially, in their words. We saw the unemployment rate fall, for a couple of months, July, August, September. As Tom pointed out, it bumped up a tenth of a point in November, I think, and then the December read came in at about 7.7. Well, mid-December, the board said that they like the idea of what they'll call the Evans rule, or what others are calling the Evans rule, which says that accommodative policy should continue until the unemployment rate is less than 6.5%, as long as short-term inflation indicators are not running above 2.5% annualized, and long-term inflation expectations appear manageable, which is kind of a loose term, but we have to start somewhere. He had been talking about this, Mr. Evans, for the last few years, using 7% unemployment and 3% inflation. So there's some speculation, I guess, that maybe he wanted to lower the number on inflation to 2.5% to be more accommodative to inflation hawks out there, especially those like maybe Lacker on the Federal Reserve Board, who are real inflation hawks. Lacker doesn't like this idea anyway. He still voted against it, or was a dissenting opinion in the December statement, because he really does not want to focus on unemployment at all. He thinks it's the Fed's job to promote low inflation. So all of the quantitative easing has not been a good idea to him. So anyway, this here is the 10-year yield. It's the benchmark, and this is the point where The Fed statement comes out in support of the Evans rule: 6.5% unemployment, 2.5% inflation. As you can see, the market for 10-year appears rather lumpy and uneven throughout the quarter. This actually was pretty mild. If you do the numbers, this was about a 30 basis point range on the 10-year in the fourth quarter. That turned out to be the mildest trading range that we've seen all year long. So despite this appearance of a roller coaster, if you look at the scale a little bit differently, it turns out to be rather mild, and we'll look at that later. Okay, so here are the numbers that we saw for the quarter. For the most part, it was pretty good. Like Tom's equity piece, on that side there was a thirst for income. No different with fixed income. Those who are willing to take more risk were paid for doing so. This was one, even though it was not a clear case that everyone who took more risk was evenly rewarded. It did turn out to be a pretty good quarter overall for fixed income. But we saw high yield and emerging market debt do very well. Multi-sector income, which has a lot of the unconstrained bonds, they also did especially well. And then down at the bottom, high yield muni. But we're going to look at some of these point by point and not cover all of them. So the first one I want to talk about is TIPS, Treasury Inflation-Protected Securities. This is the yield on TIPS over the past year, and as you can see, we had this kind of anomaly at the beginning of the year where TIPS actually had a negative yield. Well, that negative yield just got more and more negative, and in the shaded area you see the fourth quarter where it may have hit a bottom. It's trading at a range right now with a negative yield of about 70 basis points. So but you're still getting paid if and when inflation creeps up. So it's the situation with TIPS has gotten a little strange, and part of the reason why we've touched a bottom here is on this next slide. And this is the TIPS break-even rate. This is the 10-year constant maturity Treasury minus the 10-year constant maturity TIPS. And as you can see, we're right at about 2.5%, so 250 basis points difference between them. Again, TIPS have that negative yield. The 10-year, as we saw a little bit earlier, is about 1.8 or so percent yield. 2.5% difference is historically high. We can look back to the mid-2000s and see that that was typical back then. It's a rather expensive area for TIPS. So right now, TIPS do appear to be overpriced. I'll talk about this in my outlook a little bit more. But as you can see from this, we seem to have hit a wall as far as the value on TIPS is concerned. So I would not look forward to a stronger performance of TIPS next year. For the quarter, TIPS funds, they did okay. They were up about 68 basis points. The floor started to fall out from underneath them in December when they lost about 42 basis points. Everybody turned their backs on treasuries in December, so no surprise that TIPS lost ground. One of the worst performers in December. So here we're looking at various tenors over the quarter. Now you get an idea of how relatively flat the trading was. 30 basis point trading range on the 10-year, slightly more than that on the 30-year, the 3-month, the 1-year, the 2-year, all very flat as well. And then this leads into, well, we can talk about a little bit of performance here. For the quarter, we saw some of the short-term treasuries, like the short-term U.S. Treasury group, lose about 8 basis points on the quarter. For the year, they were up about 32 basis points, so you didn't get paid to hold treasuries, at least not on a short-term basis. Longer-term stuff like the 30-year, the high duration products lost ground. General U.S. Treasury shed about 86 basis points in December, about 37 basis points for the quarter. On the year, however, they earned about 2.25%. So being very cautious, tended to pay less this year. General theme to consider. The next slide we'll take a look at is changes in the yield curve over the course of the last 2 years. So last 3 years. So really couldn't tell much of a difference between the composition of the yield curve at the end of December this year versus end of the year 2011. Both are substantially lower than where we were at the end of 2010. I would reckon that in the quarter ahead, 2 quarters, 3 quarters, it's going to take a lot of effort to move beyond the current state of things. We don't seem to have a lot of momentum in the fixed income market in either direction. So yeah, fair amount of inertia. Now I've highlighted a couple of groups to talk about. First one, intermediate investment grade debt funds. This is the largest group out there in terms of assets. This is the group that tends to benchmark the Barclays aggregate. For the quarter, this group was up. They're up 69 basis points. For the year, 6.81%. That's a very good return considering where inflation is at right now. So it was a fine place to be. The next group, high yield funds, was definitely one of the best performers of the quarter. It was up about 3.06%. The annual return was over 14.5%, so it was really on par with equities. You got paid equity returns for taking on high yield risk, which with a default rate that is still very, very low. This was an exceptional year for high yield funds. The next group down from that is corporate debt BBB. This was interesting. They tended to do okay for the quarter. They're up about 1.3%, hitting about 10% on the year. That is a fantastic return for BBB. Again, equity-like returns for holding quality paper. Looking down from there, emerging market debt funds, another exceptional quarter for them. They were up about 3.6%. They returned almost 18.5%. So even better than most equity funds, on par with some of the world equity performance that Tom was pointing out earlier. So really kind of a strange year for fixed income in that they were paid handsomely for risk that didn't materialize. There were concerns, of course, and everyone's betting on what they don't already know. And in this case, taking on risk definitely was the best way to go. International income below that reflected some of the dollar's weakness in the quarter. They were up about 3.9%. No, I'm sorry, I got that wrong. They're up 50 basis points for the quarter, up about 7.4% for the year. We'll talk more about international income later on. So here is another look at corporate debt performance. As I mentioned, high yield did especially well. Right about mid-November, after the election had concluded, we saw high yield start to assert itself. People began taking on a bit more risk. This coincided with a turn in equity markets as well. These tend to run very close with equity market performance. Meanwhile, AAA and BBB paper tended to just kind of sit in a very range-bound pattern. We saw BBB on the index up a little bit less than 2% on the quarter. AAA actually lost a little bit of ground. As I said, high-quality paper kind of went out of favor as the quarter progressed, especially in December when people started to dump it, figuring that there was some good momentum, some good money to be made taking on risk. We touched on some of these already, tips in short-term Treasury. I think I got these slides mixed around. So here again, one thing we didn't talk about, general U.S. Treasury being the worst performer in fixed income for the quarter. Again, that had everything to do with the high credit standards in this group. They took on a lot of duration risk, and as we saw, that didn't really pay off so well on the yield curve, which just kind of twisted in the wind for much of the quarter. Global income. Here's where we see what happened with the U.S. and the rest of the world in a very general sense. The red line here is global government index. Very little volatility. It tended not to pay very well either. But the U.S. benchmark, the 10-year, showed more volatility. So this just goes to show you how the rest of the world is looking at government paper outside the U.S. It's less volatile in this past quarter. This might pose some interesting performance variation in the quarter ahead as perhaps people start to look outside the U.S. for holding quality paper. Not to say that that Uncle Sam will not be the world's reserve currency, but I think some governments, indirect bidders, might start looking outside our own auctions. So here is a view over the past year, global yields then and now, looking at year-end periods. The first one is Greece. At the end of 2011, their 10-year paper, and this is all on these countries' 10-year paper, yielded over 36%. Today that figure is around 12. So those who bought Greek paper a year ago did exceptionally well in 2012. The euro did not fall apart. There is even though the argument could be made that the Greek people are still are suffering under the austerity programs, I think the investors are much less concerned about Greece leaving the euro now than they were a year ago. When we look out on the rest of the world, Italy is another one. It's the fourth one from the left. Their yields have come down substantially. Canada, U.S., Japan, not much of a change. Hong Kong as well has seen yields come down. So overall, stepping outside the United States for income was the better place to be. We didn't see that exactly in terms of fund performance. I think again because this is before the currency translation. So we would estimate though that if you were holding Greek bonds, you did very well no matter what currency you needed to change them into. Here's my outlook for the year ahead. I do believe that high yield and tips looked expensive. We looked at tips. High yield just broke through 6% on its index. This is the lowest that it's ever been. And so to take on the default risk of high yield of junk bonds, you're looking at less than 6% coupon. So it's not exactly a compelling story. We've seen high yield flows turn the other direction, and Matt will talk about that again. But overall, those two I think look most vulnerable. I think it's going to be a tough year for govies and treasuries. Again, with interest rates very low, there's a price to be paid, and I think a lot of investors are looking at these yields saying, you know, equities had a pretty good run. Maybe we'll give them another opportunity. I think that quality may outperform or surprise people. High quality corporates had a bit of a rough end to the year. I think that might be the place that starts to shine first. And of course munis. We didn't talk too much about them today. For the quarter, we saw that municipal debt funds did not have a great run. They gained on average about 63 basis points. We saw high yield muni up about 1.9% on the quarter. For the year, however, they returned 14.13%. That's exceptional. That is before tax. I'm sorry. That's So on a after-tax basis, that did exceptionally well relative to the rest of the fixed income universe. So I think high yield muni might still have some legs to it. I think the rest of the muni space also probably was sold off in December with concerns not only about the fiscal cliff, and the changing tax rates. But now that we've seen the worst of that already known, that uncertainty has been removed. And I think that might even provide a more compelling case for munis, since some high quality or high income earners will now face higher marginal tax rates. So I would look for some munis to do better in the quarter ahead. And I will now turn it over to Matt Lemieux.